Today, I will share how to find a perfect entry. A perfect entry point based on the confluence of 3 time frames. And this is a video from A to Z. From the first step of looking at the chart to finding a beautiful entry point and trade using only price action. Let's get started. The 3 time frames I usually use are the 4-hour, 1-hour, and 15-minute, or the 4-hour, 1-hour, and 30-minute. Depending on the currency pair or the type of commodity I'm trading, I use these 3 time frames. Simply because I have a lot of time. I'm a day trader who only trades within the day. If you don't have as much time as I do because you're busy with business, or busy with a full-time job outside, then use larger time frames like daily, 4-hour, 1-hour, or weekly, daily, and 4-hour. The analysis is similar. It only differs in the waiting time, until the price hits the take profit, TP, or stop loss, SL. So, what's the purpose of these 3 time frames? The largest time frame is to determine the market trend. Uptrend, downtrend, or sideways. The purpose of identifying the trend is to let us know what we're looking for: a trade, buy when the market is in an uptrend, sell when in a downtrend, or stay out when the market is sideways. It's as simple as that. The second time frame is to identify the price behavior structure, price break and retest. The smallest time frame is for finding the entry point, based on price patterns, candlestick patterns. Now let's move to practice. In this example, I use 3 time frames, 4-hour, 1-hour, and 30-minute. First, I go to the largest time frame, which is the 4-hour, to find the market trend. The current market trend is an uptrend. Not because I drew a trend line, but because the price made higher highs and higher lows. That's why I identify this as an uptrend. In an uptrend, naturally, we look for a buy order in this case. Looking at this chart, I know many of you will be worried and hesitant, because there was a large downtrend before, and the uptrend I just mentioned is just a pullback wave of a larger downtrend. So, we should be looking for a sell order. So why are we looking for a buy order? Let me clarify. In this largest time frame, I only care about what the price is doing at the current moment, and what's happening closest, which is this price zone. And I really don't care about what happened behind it. Because if I care about what happened behind it, like in this case, a large downtrend, and this trend is just a pullback, so we should look for a sell order, right? But if I zoom out, then here, isn't this a large uptrend? And the large downtrend I just mentioned is just a pullback of a larger uptrend. So, we should look for a buy order again, and it goes on and on and on. We'll fall into a loop with no way out, and we won't know what we're looking for, a buy order or a sell order. That's why, in this largest time frame, we only care about this price zone. The price zone at the current moment and closest to us. An uptrend, and we buy. It's as simple as that. Now, I move to the second time frame, which is the 1-hour time frame, to find the structure and behavior of the price. Here, the market has made a high, and the price has broken through that high, supporting an uptrend. It's very good, and the price is pulling back. So, where does it pull back to? Honestly, we can't know for sure. It might pull back to here, the old high. Or it might pull back to here. Our job now is to wait. And the price has returned to the key level. Returned to the old high. That's why I go to the smallest time frame, which is the 30-minute time frame, to look more closely at the price reaction and to find the entry point. And here's a note. We only enter trades at key price levels. Of course, after we have clear confirmation from price action. The price has returned to the key level and immediately bounced strongly upward. Most traders New and impatient traders will immediately enter a buy order, in this case, buying upward. So, is this buy order okay? Honestly, it's not okay at all. Because the price returning to the key level and reacting is a completely normal thing. It might react a little or a lot. If it reacts a little, we usually don't pay attention to it, but if it reacts a lot, like in this case, then this key level, this price zone, has the potential to hold the price, and the trend might reverse. But if we enter a buy order right away, in a downtrend, just because of a sign that it might reverse, then we're gambling. We're trading against the trend. And trading against the trend has a high loss rate. It's very high. So, what do we do next? We do nothing, we wait. After the price reacts to the key level and bounces up, but it still fails to break through this old high. It failed to make a higher high, higher than the previous high. This shows that the downtrend is still continuing. But when the price returns to this key level, again, this key level still holds the price. It still reacts strongly. Even the next time, it reacts even more strongly, stronger than the previous time. Why? Because when we see two red candles as large as these, even the next candle has a longer body than the previous candle. This shows that there is a very strong selling force pushing down. And when we see two candles, large red candles like this, we immediately think this key level won't be strong enough to hold the price. But no, it still holds. When we see two large red candles like this, we predict the next candle will also be a red candle pushing down. But no, it's a green candle. This shows that right below, there's a strong buying force, buying up to balance the selling force. And the very next candle, the sellers try to push down again. But once again, the buyers push strongly upward. The evidence is the appearance of a pin bar candle, which is extremely strong in this case. This shows that at this moment, the buyers have defeated the sellers. So, what do we conclude? This is a sign that this key level has the potential to hold the price, and the trend might reverse. And this is a confirmation that the initial sign was correct. That's why we will enter a trade. Buy in this case. So, this buy order in this case, is it okay? Is it a perfect entry point? For me, this is only a good entry point. Not a perfect entry point, and why? Let's look back a bit. The current trend is still a downtrend. Nothing has changed that. So, where is the good entry point? Where is the perfect entry point? The perfect entry point always comes after the good entry point. Our job is to wait. So, wait until when? Wait until the price breaks through the trend line. And more importantly, breaks through the old high. Returns to retest it. Retest until when? Retest until a candle appears. That's no longer a hesitant candle but shoots upward. This is the perfect entry point I'm talking about in today's video. And this is also the golden point and the confluence point of the 3 time frames. Where is the confluence? It's at the 4-hour time frame. Which is in an uptrend. The 1-hour time frame is also in an uptrend. When the price has made a high, broken that high and returned to retest and succeeded. And more importantly, the 30-minute time frame is also in an uptrend. When the price has broken through the trend line, more importantly, broken the old high and returned to retest and succeeded. That's why we will enter a buy order. In this case, the stop loss is below the key level, and we have 2 targets. The first target is this old high. And the second target. We go to the larger time frame. which is the 1 hour time frame. Scroll to the left at the price data closest to us, and we look for the price zone, where the price was previously held back, where a struggle occurred and the price was held back, which is this price zone. We set the take profit at this price range. And we set the risk-reward ratio to 7. Now we let the market run. When the first target is reached, move the stop loss to the entry point. The price has made a low, continue moving the stop loss to this low. Continue moving the stop loss to this low. And finally, the price has hit the take profit. And that's how to find a perfect entry point based on the confluence of 3 time frames. I don't dare say the win rate is 100%. But I can confidently say, based on my entire trading career, trades like this have an extremely high win rate. And when you find the confluence of 3 timeframes, stop hesitating. Enter a trade with the stop loss below the key level, and confidently let the price run in the direction it's supposed to. If you don't fully understand after the first watch it again 2 or 3 times, and more importantly, practice it a lot. Because every time you practice, you take a step closer to the path of success in trading. Thank you for watching my video. Don't forget to like and comment to let me know your opinions. See you in the next videos.